So, folks, with strong economic data out this morning, the midterm elections behind us, and the Fed announcement ahead of us, what's the smart investment play? We have an all-star panel. David Joy is Chief Market Strategist, Columbia Management. Keith Springer, President of Springer Financial Advisors. James Altucher, Managing Director at Formula Capital. And Matt Shapiro, MWS Capital. James, start with you. Pre-Fed, what is your takeaway from last night's elections? In your gut, are you going to shift any investment strategy as a consequence?
Well, I think particularly after last night's election, I think Bernanke is going to be more interested than ever in doing quantitative easing. He's going to be nervous that there's going to be perhaps some spending cuts, so he's going to want to be on the other side of this, dropping dollars onto an economy that he thinks is still deflating, even though we get nonstop good economic data. One stock that I think absolutely will benefit, Assured Guaranty, AGO. They insure municipal bonds. With lower yields and investors taking higher risk, municipalities are going to have an easier time refinancing. AGO absolutely benefits, trades for only 4 times earnings. I think that's a home run in a QE2 scenario.
Well, Keith, is James right? Is there a chance that QE2 could actually surprise to the upside north of $500 billion, in part because of last night's win for the Republicans?
I don't think it has anything to do with the win from the Republicans, but it better come in better than $500 billion. The market is really expecting a lot more. I think it's expecting probably $100 billion a month, closer to $1.2 trillion over the year. That's really what's going to surprise on the upside. The market has a lot built into this. It's had a lot built in with the Republican victory, which, by the way, is a perfect scenario. We should never have one party in control of all parties of the House. And I think that's going to really create a scenario very, very positive for the market. And I think what the Fed is telling you here with the quantitative easing is there really is no risk of inflation, and rates are going to stay low for a long, long time, and you want to focus your portfolio.
Did you see the prices paid index in the ISM that Steve Leisman showed us earlier?
I did. I heard them on, and I think it's very positive. But again, they're not over the top. We're now approaching where the level of supply and demand in the economy really needs to meet. It's not gangbusters. It's definitely positive. I give you that, and I'm happy to see that number. But it's not gangbusters over the top. Remember, we need 125,000 job growth every month just to break even. I think it's very positive for the economy and very positive for the markets. And QE2 is going to be very positive for stocks.
Yeah.
A lot of it's already built in. We're probably going to have a little sell-off, but it's going to be very shallow. But going forward, this is really a lot of fuel for the fire.
Yeah.
Very, very positive, you know, and clients and investors have to really look for where's the sweet spot. You know, that's what we do for our clients.
Yeah, David, I mean, the real question as to what trading is going to look like after 2:15 today is how much is already priced in. What's the number that you think is priced in, and what do you think we'll really see?
Well, I think $500 billion is priced in. I think the Fed's going to take a gradualist approach and maybe let the data dictate. But I think in their minds, they're going to be north of $500 billion over time. I think the Fed is very, very nervous about the prospect of deflation, especially this Fed headed by Bernanke, who's a presumed expert on the Depression, and he lays the blame for that on the Fed's contractionary monetary policy. He doesn't want to be blamed for repeating the mistakes of the past. So I think they're going to surprise over time by going north of $500 billion, and I think that will come as a modest surprise to the markets and represent a tailwind and push prices higher over time.
Matt Shapiro, with the Republican sweep in the House and the Senate very close to even, do you anticipate any tax and regulatory barriers coming down that might assist the overall market or specific sectors? For example, the energy sector under assault from the EPA and the healthcare sector under assault from Obamacare. Is there any lightening of pressure? Anything that piques your interest where you want to sniff around and buy something?
Well, definitely, and I think last night's elections were a big win for the market, which was that the Republicans have the ability to ease up the pressure, as you said, on some of these oil industry and the Obama health care initiatives. So I think there's going to be a lot of fiscal work in terms of tax breaks for investment and employment that's going to help the market. Now, back to the quantitative easing, I think this is one of the most crucial Fed announcements in a long time, and I think they really need to have a big number out there, take the total amount up to $3 trillion, because the Fed is really making a big bet that rising stock market is going to save us.
I am astonished. Not a single one of you mentioned the downside risk to the Fed's quantitative easing regarding something called the U.S. dollar falling out of bed.
That's because everyone knew you'd say it, Larry.
Not a single one of you mentioned that. You're all into this free money yip-de-doo, just pour
All right,
it
we're
on.
going to talk about that. We're going to talk about that. We need to talk about the U.S. dollar.
I am totally astonished.
It's actually gaining a little ground today, up about 0.2% there. Stick around, guys. We want to talk more about how you're going to invest on the back of the elections. We want to talk more about that U.S. dollar, all ahead of the Fed's new round of easy money. Okay, we want to continue with our all-star panel. We're looking at the smart investment plays after the midterm election and ahead of the Fed's new quantitative easing announcement expected this afternoon. With us, David Joy, Chief Market Strategist at Columbia Management, Keith Springer, President of Springer Financial Advisors, James Altucher, Managing Director at Formula Capital, and Matt Shapiro from MWS, Capital.
All thinking
guys,
about the dollar during the break.
Exactly. You heard us right before we went to commercial.
This is a free money group. Pour free money onto the economy.
Here's my question. I mean, some of the economic data we've seen as of late is looking more and more optimistic. With that in mind, is perhaps the Fed a day late, dollar short, no pun intended, when it comes to this easing? Do we actually really need it? And James, aren't you concerned about the long-term consequences for the dollar as a result of this easing?
Yes and no, Trish. I think we don't fully understand what's going to happen here because this could just be the first shot fired in a global devaluation war. I mean, no country wants their currency to surge.
So that
here.
makes it okay? Everyone's going to do the same thing? It's a race to the bottom?
It doesn't make it okay, but it could be a race to the bottom, and we just don't know what's going to happen. I wouldn't necessarily bet on a weaker dollar. We do know money's going to flow into stocks, money's going to flow into bonds, the economy's going to feel at least artificially and positively stronger, but we just don't know what's going to happen in terms of the dollar versus any other currency as all the currencies race to devalue.
Well, we may not know with total certainty. I agree with that. But we know some things. For example, Keith Springer, the front page of the Wall Street Journal, the lead story. Central banks are tightening, Australia and India. The European Central Bank is not happy with the Federal Reserve because the ECB does not want quantitative easing, a.k.a. free money, let your currency go into the sandbox of history. I mean, the lower dollar may be good in the very short run, but what about these incipient inflation pressures? What about a 25% year-on-year gain in the commodity indexes? What about the price indexes? Both the ISMs that came out yesterday and today, the manufacturing ISM and the services ISM, they're both showing about 70 on the index for prices. Does that not concern you?
Well, inflation's not my biggest concern, and I do agree with you, Larry. I don't support the QE2. It's here, and my answer before was basically in the short term, a very short term. Longer term, not only do we not need it, I don't know what the effect is going to be, if any. The biggest thing is demand in the economy, and there really is no demand, and you're not creating more demand by putting more debt. I mean, isn't that the way we got into this problem to begin with? An over-indebted, over-leveraged population, and we're throwing more debt on them. So I'm not a big supporter of it, but we have it, and it's going to affect the stock market in the short term. Inflation really is not the biggest issue. Deflation, I still think, is a bigger crisis problem for the Fed because they see assets being destroyed faster than they can inflate. And that's what they're looking at. I understand that consumer prices are starting to rise and we're starting to see commodity prices rise. But the Fed is looking at asset prices being destroyed so fast, faster than the Fed can actually inflate with. And they're really worried about deflation hitting the economy and affecting the economy negatively that way.
Okay.
And that's why we're going to have long-term interest rates really, really low for a long time. And that's where the sweet spot is in the economy.
Okay, so Matt, why does that make you want to pile into Caterpillar? Do you think that we need a lot of front loaders to load all that money out into the economy, and so they're going to be a good buy, or?
Well, actually, playing on Larry's, point of view that the dollar is dropping, and we are playing, frankly, a dangerous game of monetary high wire act. However, the Fed is obligated to try to spur the economy, and they've bet on a rising market. So a stock like Caterpillar is going to benefit from worldwide demand and the competitiveness of U.S. exports.
And how about Starbucks and Altria? Why do you like those guys?
Well, again, in a rising market spurred by the Fed, I want to be in big, profitable stocks with very high return on equity. And Altria and Starbucks both fit the bill, just like Caterpillar with that worldwide demand picture.
But David Joy, let me come back to you on the election, to try to put the election together with the Fed. Okay, we're all powerless against the Fed, and we don't know what exactly is coming out today, but can one hypothesize, this is for investment purposes, you're going to have some kind of rollback of taxing, some kind of rollback of regulation, and some kind of rollback of spending, okay? That's a hypothesis. If you disagree, I appreciate that. And therefore, that could help business confidence to put the profits to work and the $2 trillion of cash to work to resume hiring and investing. Now, it seems to me that would be very optimistic for the market as a whole. What's your take here?
I agree with that assessment, and for that reason, Larry, I don't think the market needs to sell off here. I think all of a sudden sentiment within the business community has been raised as a result of this. However, I also think that the Fed is very mindful that the consumer sector continues to deleverage. And I think what they're trying to do is buy time for that process to run its course, at which point then they'll start to ease back. I think, however, that's a 12 to 24-month process. This recovery, even though it's picking up a little steam, it's still very narrow. It's mostly in the manufacturing sector, and the consumer still needs more time.
Will extension of the Bush tax cuts help? Will the extension of the Bush tax rates help? James Altucher, last word.
Absolutely. And I just want to add also, we're having 6 quarters in a row of GDP growth. Things are not as bad as everyone's kind of implying.
Right.
There has been steady economic growth on every indicator.
Yeah. Okay, guys, thanks
good.
so much for joining us. The Fed decision, of course, happens live during Street Signs, where the markets get an understanding of QE2. We have the reaction from an all-star panel. You don't want to miss it.